Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This week ends with a Friday the 13th, and the markets did not go down as we expected them to last week, so I've erased those lines and I'm going to redraw the lines so you can see where the new boundaries are for the market, not just with the Dow Jones Industrial Average but with all the other major indices. And at the end of this particular video, I want to lead you to the next educational video that we're going to be posting. So I'll give you just a little sneak preview of what that's going to look like so you don't miss that as well. This is the Dow Jones Industrial Average ETF, ticker symbol DIA. And since February 2nd, we've gone almost vertical here. And if you've been following the market, guys, long enough, you'll know that when the volume is dropping in an uptrend, that tells us that the buyers are weakening, especially when we are hitting points of resistance. You can see that back here on December 26th, which is the high that I'm drawing this line from, you can see that if I draw that horizontal, we closed just a few pennies below that high, and the volume has been steadily dropping on the highs. That's point number one. Number two, we have a gap still down below the market. Gaps generally fill about 80% of the time, so what I'm forecasting is a pullback to that gap in what we know of as a trading channel. A high resistance, low support, and I think that we could pull back to that gap before bouncing and moving higher in a retest of those highs. So that's the diamonds, and watch out for that ticker symbol DIA. A more broad-based index is the Russell 2000, and you can see same thing applies. We have a high point right there. We've reached that high. I expect the market to pull back to retest support down here right around 1150, so I will leave those lines on there for you as well. So that's a Russell 2000, again a more broad-based index. Looking at the spiders, that's the S&P 500 index. That is looking also at a point of resistance. We could even draw these highs connecting them. It doesn't have to be perfectly horizontal. In fact, you can connect the lows parallel to that, and you'll see that yes, in fact, we are in another trading channel. The spiders also having a drop in volume. If you look down at the bottom of my chart, you'll see the volume bars. I'll zoom in there for you so you can see that more clearly. And we have a gap down below the market. So I'm going to draw this line down to fill that gap. You know, when we look at the support and resistance areas, that's one thing, but we also have to look at the colors of the candles and how long these colors last for. We'll call that a stale green light is what we're looking at in the Qs. That's the QQQs, NASDAQ market, power shares. We have 1, 2, 3, 4, 5 up days in a row. Again, almost vertical. So what I think is going to happen here is that we will pull back to a roll reversal support line, and I think the forecast will look just like that. Now, let's be real. Your trading is not going to be 100% accurate. In other words, 100% of the stocks that you trade are not going to be profitable. You have to expect that the markets will go left when you think they're going right, or go up when you think they're going down. And you have to move with the volatility. So if we are drawing support and resistance lines and the markets don't go according to the forecasted trends, then we roll with that and just put together another strategy, as long as we are protecting our positions against an opposite move. So in other words, if you're buying and you don't have sell stops below the market, you are violating the rules for risk management, and you don't want to do that. You have to make sure that your strategies are in place for risk management, and that you are coming to the realization you're not going to be right 100% of the time. At the market, guys, I've been right about 87%, almost 90% of the time, and that might impress a lot of people, but you have to understand that that means I'm wrong 10 to 13% of the time. And you have to prepare for those times. So last week was one of the times that we were wrong, but now we readjust. It's as simple as that. Now let me show you a little bit about what I'm talking about with regards to pairs trading. I'm going to take the oil service holders. This is just a random 1-year chart. I'm not really projecting direction or anything like that. I want to show you something, and I'm going to throw on a quick study here where I'm comparing the OIH to one of the stocks that are actually held within the OIH, and that's ExxonMobil. I'm putting in XOM. Now you'll see that the lines have changed. We have a candle chart, but we also have these magenta colored line on the chart that represents ExxonMobil. Now, a pairs trade is when you see two stocks that are related to each other diverging and converging on one another. In this case, ExxonMobil, the line chart, has moved up and away from OIH, which is the oil holders. A pair strategy is when you buy the lower one in equal dollar amount, expecting it to go up, while you're shorting the stock or index that's above the previous stock I just mentioned. So in other words, you can see that when these wide divergences occur, you could have shorted ExxonMobil up here when it was trading around 93, and you could have bought OIH when it was trading down here around 36, and you would have taken off the trade when they come back and touch one another on the charts. It's as simple as that. So for this case, and this is for educational purposes only, because this is going to stay on our website, and I don't want people to reacting to this when it's a dated report. But in this case, you would short XOM, expecting it to go down, and you would buy OIH, expecting it to go up. And when those charts touch, you unwind the position. Now, there might be a case where they both go up. You know, again, it doesn't always work the way you expect it, but we do know that over time, these lines converge every so often. You can see here, they converged. Here, they touched. Here, they converged again. Here, they converged again. So let's say ExxonMobil goes up, but because the oil markets have gotten so bullish, we now see OIH also going up, but they wind up converging up here. You make money on the long side, a lot more of it, than what you'd be losing on the short side. So our next educational video is going to talk more about pairs trading, and I'll show you some of the pairs that work very well, and whether or not you actually trade these. This is a great educational exposure for you because it's something that's very conservative in strategy, and when done correctly, it allows you the opportunity to stick with a position longer without having to worry about losing in a catastrophic loss. So it's more or less a hedge position. So enjoy the long 3-day weekend. Monday the markets are closed. Tuesday they will reopen. And for those of you who are Oracle subscribers, the trade alert should be in your mailbox by now. So have a great weekend, folks. So long.